So lots of people are now asking, is this a good time to invest in the UK? And I know with everything going on right now, it might also seem like it's probably one of the worst as well. If you saw my recent videos, I spent time covering all of the issues with the weak pound, high inflation, the mortgage crisis, and whilst things have thankfully changed pretty quickly, there's certainly still loads to be worried about out there. However, as investors, sometimes we've got to take off our hats and put on our Warren Buffett inspired specs on, because don't we always get told that when others are fearful, we should be greedy? So let's have a whistle-stop tour of the UK markets. We'll compare the kinds of companies you can invest in. We'll look at how the UK's performed up until now. And then I'll also give you some ideas that you might want to research a bit more into before making any decisions about adding the UK into your own investments. And just before we jump into that, Liz, what do you reckon? Is this a good time to invest in the UK?
We have never had it so good.
Well, let's get into this. All right, so the UK market, here's what it looks like from an investing standpoint. We make up around 4% of the global economy, which puts us in 6th place, sitting between France and India. And then as part of the world from a stock market perspective, we're somewhere up there in the top 10. And as you can imagine, the US markets are the largest in the world, with the New York Stock Exchange and the Nasdaq dominating pretty much anything else. Now, quite interestingly, one thing worth saying is that the stock market in the UK doesn't necessarily represent the UK economy. And all that means is that the kind of companies that you can invest in on the stock market don't do all of their business here, and they don't have most of their employees here in the UK either. I'll show you here. If you take a look, let's grab the FTSE 100, which is an index of the biggest companies on the London Stock Exchange. As you can see on screen, here's the top 10 biggest companies by their market cap, which is just a fancy way of saying the total price of all the shares added up together. On top at the moment, you've got Shell, the oil company. You've also got BP there from the same industry. And then outside of that, you've got some pharmaceuticals, as well as banks. And then don't forget consumer goods like the drinks maker Diageo, and then even tobacco maker British American Tobacco. To put this all into perspective and to give us some context, Shell's got a market cap of £165 billion, which is pretty much worth the same in dollars. Thanks, Liz. Only kidding, it's probably worth around $188 billion or something. And while that's a massive company by all means, when we compare it across the pond, the largest company in the world, Apple, currently is worth $2.35 trillion. So you can fit 10 Shells inside an Apple. In fact, forget just Shell, you can fit the entire FTSE 100 inside of Apple, as that one company is worth more than all of them combined, at least at the moment. Okay, so it's a strange mix of companies, definitely a lot different when compared to the S&P 500 over in the States. There's almost no technology stocks or anything like Tesla that's grown really fast over the past few years. So does that mean that you can't make a profit here and then it's a bad investment? Well, not quite so fast. We still need to consider what the total returns might be for the future. There always seems to be loads of people out there saying that the US market is overvalued and places like the UK are cheap to invest in, so let's have a look and see if that might be true. Now, if we quickly look back and we compare the FTSE 100 to the S&P 500, here's what it looks like when we put the two together over a very long period of time. Ooh, Liz, what do you reckon about that performance?
That is a disgrace.
It doesn't look good, does it? But just be careful, that only tells part of the story. Don't forget, when it comes to investing, you need to think about things like dividends as well, and this is where the FTSE 100 actually makes most of its gains from. Let me show you this graph to help. If you'd invested into the FTSE 100 back in 1999 and then you'd left it for 20 years, if you hadn't invested your dividends back in, you would have ended up with £1,088. So pretty much flat, and some dividends along the way sat in your bank account somewhere. However, if you'd actually reinvested those dividends as soon as you can, you ended up with more than double what you started with, as you can see on these light green bars on this chart. In comparison to the S&P 500, and to make sure we're paying fair, this index also does pay a dividend, but it's a lot smaller. Now, you'll find loads of opinions on dividends being a good thing and a bad thing. Some people will argue that dividends are annoying because they create headaches for people's tax bills, or they think it means that companies who pay them out have nothing else to spend their money on, meaning that they're not very good at innovating with that cash. And while both of these things can be true, Liz, what do you think?
Well, they are wrong.
Okay, no need to shout. Don't forget, that can also be the sign of a mature company that's very stable and has the ability during both good times and bad times to keep giving cash back to shareholders. After all, when you invest in stocks, you're entitled to the profits of the company, and if some of that comes back in cash, then so be it. If you look back through history, you'll see that some of the best companies in the world have actually paid dividends consistently for a really long time. Now, if we take the example of Warren Buffett's favourite drink brand, Coca-Cola, this is a company that's paid dividends for more than 50 years. And during this time, it's also grown massively too, so you can have both at the same time. Now, from a UK perspective, there are loads of companies on the FTSE 100 that have managed to pay dividends for more than a decade and continue to increase their payments year after year. And also, if if you look a little closer, you'll find ones that have been able to pay dividends and grow faster than the market too. If you want to find information like this, by the way, quite a useful site I like using is called dividenddata.co.uk. You can basically see all the different payment dates and ex-dividend companies, and you can also see who's been paying dividends for the longest and if they've been increasing them as well. Right then, so lots of dividend payers and mature companies that have been around for a long time, but we're still not sure if it's a good time to buy. The FTSE 100 is hovering around the 7,000 points mark at the moment, so it's still a good 10% away from all-time highs. And then if you also look at the FTSE 250, which is the index of the next 250 companies after the FTSE 100, you'll see that there's potentially more opportunity here as they're more than 25% down from some of their highs. I think it's fair to say that there's been plenty of negativity in the global markets that have been priced in, and lots of people think we're heading into a global recession. We obviously had that recent pound collapse, which has recovered mostly to get us back to where we were before the mini budget, but we're still not out of the thick of it just yet. Also, if we look into some of the sectors that have been hit really hard recently, there could be some great opportunity here for both UK investors and those based in the US or somewhere else. I saw recently how badly hit the real estate trusts were looking last week, and this could be a really nice sector for long-term investors who want to get some exposure to UK property, especially in the commercial sector, which tends to have really long-term clients renting bigger warehouses or even office buildings. In my previous video, I mentioned a couple of names. Now, bear in mind, I don't own any shares here, or I haven't done any in-depth research, so you need to make sure you do all of plenty of your own, but I did notice big names like Tritex Big Box, Unite and Segro down loads since the start of the year, and some of the prices are around the same level as during the start of the pandemic, during the stock market crash. So potentially there's some huge opportunity there if you see that sector having a future of strong returns. One good thing about REITs like these is that because of the way they're set up, they have to return profits back to shareholders, so you'll get a steady income so long as they actually make a steady profit themselves, of course. Nothing's ever guaranteed, but if you did want to take a look, feel free. Don't forget that if you do want to start with any investments, I always keep links in the description that you can use to either get free shares or free cash to help you get started. So check them out below. Other shares in the UK that I had a look at the other day as well, Rolls-Royce, another name that's massively down right now, trading at levels it was back in 2004. And then you've even got Royal Mail, which is down 60% year to date. Again, I don't own any of these, but there's always an opportunity when things are looking down to pick up some bargains long term, or just average in slowly over time if you enjoy a bit of stock picking on the side. Now, personally, my own thoughts would be that if you did want to invest in the UK right now, I'd probably choose a simple index fund and just keep things really simple and buy the FTSE 100 as a whole rather than trying to make things too complicated. If I just pull up my Trading 212 app for you now, here's a couple of options for you, and you should be able to find these on pretty much any broker as they're all ETFs, but something like CUKX, which is iShares FTSE 100 ETF, could be a pretty good pick. This one actually reinvests your dividends automatically and has some nice low ongoing costs. And then a second option that's pretty much the same is ISF, which is just one that actually pays you out the dividends in cash instead. Again, nice and cheap relatively. And then if you're a Vanguard fan, then you've also got the popular VUKE, which is a fund that pays out. Remember, just look out for the term distributing or accumulation, which then just gets shortened to DIST or AC. Then finally, the Vanguard version of the fund that reinvests in the FTSE 100 is VUKG. Anyway, feel free to go back if you missed any of those tickers, but they're always easy to find. Always double check and remember that I'm not a financial advisor. Now, I don't have any position in the FTSE 100 or the 250 yet as I film this, but I definitely might start one in the future. I do, however, have a small dividend portfolio on free trade that you might have seen where I do pick up some UK stocks, so feel free to watch that one after this video anyway. Also, I know a few of you were thinking that US stocks were going to cost you a bit more cash at the moment because of that poor exchange rate. Remember that we can't really avoid exchange rates entirely because the income that gets generated outside of the UK in the FTSE 100 in currencies like the dollar, and we need to import most of our goods and energy. And all of that ultimately ends up as a cost somewhere down the line. Prime Minister, did I miss anything else there?
We import 2/3 of our cheese.
Okay, thanks for that. Don't forget cheese. But anyway, we can't live entirely in a bubble, but if you did want to take the opportunity to invest in some UK stocks at the moment, then I think it could be as good as a time as ever. But don't forget that generally, it's good to ensure you're well diversified across many sectors and that the UK ultimately is going to be enough for most people. You could miss out on lots of future growth, and we don't know where that's all going to come from, but I think you would be hard pressed to find someone that thinks putting all of your investments in the UK is the right thing to do, even though you do get some pretty good solid global companies. So in the end, if all of this seems a bit too much, don't forget that if you do just have any kind of global index fund, then you've already got a big chunk of these UK companies already inside it, and there might not be any need to actually do anything unless you definitely want to get some UK stocks and double up while you think they're cheap. And after all, it's all up to you. If you're able to and they meet your investing needs, you might end up grabbing a bargain before the next bull market gets everyone excited again. Anyway, for now, I'll leave it up to you. Let me know in the comments if you're planning on picking up any UK investments. Drop me a like on the way out, and until next time, happy investing.